Okay, so Dan, as a notary, right? You deal a lot with estate planning.
Yeah, that's one of our expertise at the office. So our firm, Derhy Trust and Estate, specializes in trust and estate.
Yeah, and so do your clients worry about capital gains tax while they're alive more, or are they also worried if they pass?
Both, because estate planning, essentially, we help clients, to structure their estate for it to be beneficial while they're alive. So asset protection, control, succession planning in case of incapacity, also, and then of course when they pass away. So capital gain and estate tax or death tax will always be a topic in the mind of our clients, and also a concern for us in our strategies, which we'll always try to minimize.
So can you tell us a little bit about a case study last year, a really cool case study where you did a reorganization for a client?
Yeah, sure. So again, different clients, different transaction, different needs, and we had to be very creative. So for example, essentially capital gain was more of an issue for a client that owned a real estate, that a real estate transaction was happening, for example, in July, and then all of a sudden we have to rush it for June. But then again, a real estate transaction it's like a whole process involving so many different persons and parties. So sometimes it's not up to the parties to be able to rush the transaction. So for example, the most important part of a transaction is financing. And when you're dealing with banks, you don't have control over them. So a lot of the transactions that were supposed to happen in July, we try to rush them to close in June, which was not possible for our purpose. So what we had to do is essentially different strategies, but one of them is essentially selling at fair market value to a related entity with a full balance of sale, but without rocking the real transaction that doesn't happen. So we had to use like a strategy of simulation. So essentially it was an off-title transaction, so not registered, not disclosed to the eventual buyer, not to rock the boat, and not to the current lender. And we had to deal with Revenue Quebec and Revenue Canada and the city to avoid triggering welcome tax and capital gain tax, which even if we had to trigger it, depending on the case, would have come to the same objective because the tax
would have been due.
Exactly. And in fact, what we wanted to do is actually trigger that capital gain tax with the rate that we had pre this new
the
law.
50%.
Right. Yeah. What we were trying to do is actually reduce or eliminate the welcome tax, but triggering the tax right away.
Do you have any clients that regret doing all that before June 25th?
No, because essentially we did all of that for clients that were selling. So in the next couple months.
Okay. So you just sped up the process.
We sped up the process. We triggered the capital gain with the lower tax rates than the new one. So, but it was a very difficult month because we really didn't have a lot of time to realize that it was coming and then implementing it. So I think the government give us like 2 months to realize So it was a very horrible time, but we did it, and our clients were very, very happy.
Trust, wills, these are all very complex things that people need to put into place, right? We have clients always ask us, like, should I be putting a will into place? Should I be putting a trust into place? I want to eventually move this wealth that I have down to my kids, right? So the transfer of wealth that we're going to see in the next decades. 10 years, 20 years is going to be massive.
Yeah, it's going to be the humanity's biggest transfer of wealth in the whole history of humanity.
For sure. All the baby boomers, God willing, they live a long life, but there's going to be that wealth transfer aspect where, I think that's also why the government tried to implement this, to try and get their cash right away. But can you talk to us a little bit about, do I need a will or do I need a trust? And what are they?
Right. So the short answer will be you will always need a will, okay? Then the question of a trust, it depends, okay? So there's different types of trust, different strategies, different clients, different needs, okay? And it's funny because we just finished February, but from January to February is the time of the year where I say the most no for people who ask about, do I need a trust? And the reason is because everybody was, they come to the office and, my brother-in-law did a trust. He told me that at the Christmas party. And then everybody comes back from Florida from what I call the pool council. So everybody's sitting in the jacuzzi and the pool and giving medical advice and prescription. And your daughter's getting divorced. She has to do this and that. and everybody wants a trust. So a trust, it really depends on your needs. And there's different, again, there are different types of trust. A trust, we can use like the term like a vehicle. So you can have a car, a jet ski, a boat, a plane, a pickup. Depends on what you need. So trusts are an amazing creature that exists in the law. It's an entity that's very flexible, very powerful. And again, we can use trust for different purposes. It can be to manage a company, to hold a company, to do an estate freeze. It can be to hold your family residence, your principal residence, your condo in Florida. It can be used to manage the inheritance for younger kids in case they pass away. We can set up a trust for beneficiaries that have some handicaps, whether it's mental or physical.
Wow.
We can also create trust to hold the inheritance that you're going to leave to mature children, right? That even are 40 years old, 50 years old, because trust will essentially give you 3 benefits. 1, maximum asset protection. Everybody can go bankrupt, the trust will stay there. So your beneficiary can go bankrupt, you can lose everything that he worked hard to build and everything that you give him personally, but whatever is inside the trust will be fully protected. Second of all, you can have all the, you can ensure the control that you want to set up. So you can decide who controls the trust, how the money is invested, and how it's dispersed, and who are the beneficiaries of the trust. And all of these questions can be answered either because the parents, for example, can want to remote control this decision, or they can even give this control to their children. So it's not a question of controlling from your grave. You can set up what you think, what the client think is proper and best for the client. And third of all, and that's one of the most powerful benefits, is that a trust is not a tax shelter, not in Canada, but it's a great tax planning tool. So essentially, we can save money in certain circumstances that are very interesting.
What is the minimum amount of wealth that you should have or assets? Is there a certain amount, like if you have under 500,000, not worth it? If you have 3 million, at what point does it start becoming
So it's a great question, and again, it depends on the client. I'm just giving an example. If the beneficiaries are mature and capable, I would say starting $1 million, it's really worth it. For asset protection, control, tax planning. But let's say you were to leave $200,000 to a child of yours that you love, but has drug issues, gambling issues, right? So leaving him 200 grand, it's either he's gonna burn the money right away, or he's gonna accelerate his death with buying more drugs.
It's detrimental for sure.
Right. So that's why we need to assess the situation depending on the needs of the client. But in a perfectly correct situation where everybody's doing so well, I would say $1 million, it's a no-brainer.
$1 million excluding your principal residence? Or
$1 million worth of inheritance.
$1 million worth of inheritance.
And here we're talking about setting up a trust to protect the inheritance that you're going to give to your children.
Yeah, so what does that mean? What are we protecting it against?
So again, it can be their creditors. It can be controlling, making sure that it goes to the children, and after their death, it goes to their children and not to their friends or spouses or, whatever is trendy at the time.
Their dogs or whatever.
Exactly.
Yeah.
So the clients want essentially that the money stays inside the royal family. So it goes down the line, and let's say you had 2 children and one of them didn't have any children when they pass away. Well, it doesn't go again to the spouse of the children or to their friends, but it goes back to the other children, descendants. So you're keeping it inside the family, which again, even if setting up a trust costs a couple of $1,000s, it's really worth the cost when you're talking about protecting $1 million or more.
So that's super interesting. Thank you for sharing. The trust itself, do we have to reevaluate it every 21 years? Is there a certain amount of time, or is that just for asset freezing? Like, what is it? What the trust is? It a set up once and then forget about it, or is there constant?
Great question. So we hear a lot about the 21-year rule. So the 21 deemed disposition rule essentially says that once a trust is created and it's funded, every 21 year, the trust is deemed to have sold all its assets. It didn't sell anything. The trust didn't close. But every 21 year, the trust is deemed to have sold everything, so the government can collect its capital gain tax. And the reason why is because back then, there wasn't this 21-year deemed disposition rule, and wealthy family will put building in those trusts, and the great-grandfather will pass away, leaving it to the great-father, to the grandfather, to the son, to the petit-son, right, to the grandson, and all of that. And the government will never collect tax because the trust never died.
Correct.
And the real estate will have stayed inside. So eventually the government caught on that and said, you know what, every 21 years, the trust is deemed to have sold everything. Doesn't mean that it's going to create it doesn't mean that you're going to trigger tax that you have to pay, but it will trigger capital gain if there's a capital gain that has accumulated inside the trust. And the reason for the 21 years is that, a couple decades ago, every 21 year was the mark where a new children will be born, right? Now we have children more in our 30s. It used to be the early 20s, right?
Yeah.
So essentially, the trust every 21 years is deemed to have sold everything. So let's say you had $1 billion in the bank account and the trust just turned 21 or 42. Doesn't trigger any taxes because there's no capital gain on cash. Same thing goes for a bond. Same thing goes for a real estate building that was bought at year 20, right? 1 year didn't really trigger capital gain.
Right.
And so what we do is every 19 years, we don't wait the day or the month or the year before the 21 year because time flies, right? Mm-hmm. So we like to say every 19 years of a trust, we sit down and we start to look at the situation.
Interesting.
How much tax are we going to have? Are we really going to trigger? Yeah. Maybe it's not going to be substantial. Maybe it's going to be acceptable, this amount, and we're not going to do anything and trigger the capital gain tax, and we made it. Maybe that building that built a huge capital gain, well, we're planning to sell it really on year 23. So essentially, even if we pay the capital gain tax on year 21,
it's going to be paid anyways.
Exactly. We just accelerate the payment, and then when we're going to sell on 23, the capital gain will be based on the 21 and the 23. So it's not that bad. And then again, if there's such an intolerable tax that is being generated by one particular asset inside the trust,
we remove it.
We remove it in a purely, entirely Canadian environment, meaning the trust is Canadian, the asset is Canadian, the trustees are Canadian, and the beneficiary is Canadian. It's tax-free. Mm-hmm. The asset will go directly to the beneficiary.
Interesting.
Without triggering tax. And when that beneficiary would sell it or pass away, then the tax will be payable.
So what kind of assets can we put into a trust?
So very interesting. We can technically put anything except registered investments. Okay, so we can put real estate, we can put shares of company, operating companies, holding, public stocks, bonds, insurances, and insurance is a very interesting topic about that, but there's a different way to structure a trust with insurance. But essentially, you can put anything inside the trust that's a property.
Just no RSPs, TFSAs,
Correct.
RESPs for the kids.
Correct. And there's specific trust for disabled beneficiaries. And for example, disabled beneficiaries is really something that occur a lot, and we're doing a lot of plannings for families that have disabled beneficiaries. But for example, when somebody passes away and had an RSP, right? Everybody knows if you leave everything to your spouse or you leave that RSP to your spouse, there's a rollover.
Correct.
When it goes to the children,
it's deemed gone.
It's deemed.
53% is gone.
Correct. So half you give it to the government and you collect half. When the beneficiaries are minor, there's a strategy where we can take that money, buy an annuity, and essentially income split the sum that was held in the RSP until the children reaches 18. The age of 18. And then we have an income splitting strategy where essentially it's probably going to be taxed less. Of course, it depends on the amount. If we're talking about $2 million and the children was 8 years old, 10 years divided by $2 million, still going to be a lot of money. But if we're talking about 200 grand, we should see a nice saving. Now, if the beneficiary is handicapped.
Oh, handicap.
Okay. And even if he's 30 years old or whatever, adult, we can create what we call a life benefit trust, where the RSP will be rolling over to the trust.
Interesting.
And then that's very interesting too.
Do you do it before the person passes away, obviously?
So what we do is that we structure all of that inside the will. So the client still keeps in full control of their asset. They're owning their assets. They can modify their will as much as they want because situation changes, beneficiary changes, and hopefully they're not handicapped anymore. Or tax laws changes, or the clients might just move to another country, right? So it all depends. So What's great about doing estate planning is, and especially using the will as a platform to set up all of these operations, is that you can revoke them and you can modify them and update them as much as you want, and you still keep the ownership of the asset. But yes, in the strategy where we transfer the RSPs or the RIF to a life benefit trust, this is done inside the will.
It's done within the will. What I always hear is, yeah, but what happens if, in 20 years they change the laws, or in next year they change the laws, or in 10 years we change the laws, right? So I always figured that for clients, we always tell them we plan for today, and if it changes, then we change our strategy.
Exactly.
Right, but we have to plan for our current events.
Absolutely.
And so, okay, our new government that comes in, or the same government that stays, might change the laws as well.
Absolutely.
But we have to do what we can now, and not just wait until that happens later.
And that's something that I also answer in the similar way, in the sense that I tell them to my client, essentially when we're doing estate planning, we're not talking about you dying from natural cause in your bed at 126 years old, right? We're talking about, God forbid, something happens in the next 5 to 10 years. So what happens if something happens within 5 to 10 years? We need to have a plan that works. Great if it also works when you're going to be 126 years old, but let's focus for the next 5 to 10 years. And once we set up the plan, I tell my client every 5 years we have to take a coffee and we go through the plan, either in person or it can be on the phone, because usually 5 years, nothing really substantial changes. And of course, if anything substantial changes,
life events,
call me. Yeah. And then we're going to take a look at the situation and see if we need to update the will.
Yeah, any life events, we always tell our clients, if you have any major life event changes, we need to know about it right away.
And for example, what would be the major life changes?
Marriage, kids, death. For us, job changes, career changes, divorce,
moving out of the country.
Yeah, leaving the country.
Right. Sickness, like important sickness. Illness. Absolutely. Yeah. And also mental health. And sadly, what we see is that mental health is something that happens down the line.
Yeah.
Sometimes we see it in advance, but sometimes we're just very surprised.
Yeah.
And what we thought would be like a personality, the personality of the person, and becomes worse and worse over time. And then eventually we find out that it was a mental health issue.
Yeah.
That started slow, a little, and then became bigger.
Wow, there's so many segments that we could move to.
Absolutely.
You spoke about life insurance in a trust.
Right.
Why would it be important for someone to put life insurance in a trust?
So this question essentially it talks about two different types of questions. Do we hold the life insurance inside the trust? Or do we appoint a trust to be a beneficiary of the life insurance?
Correct.
And for different legal and insurability reasons and fiscal reasons, let's just make it simple that we're going to discuss now about putting, actually designating a trust as a beneficiary of the life insurance. So the life insurance can stay under the personal name. And again, it's much simpler for now. And there might be a situation where we need to put actually that life insurance inside a trust. But let's say we're just going to appoint the trust. So a lot of families have life insurance, right?
Yeah.
$1-2 million young families. And like David said earlier, especially when we're in the beginning phase of our family life, most of our saving is either injected in the house or in the RSPs, and we don't have enough money that we can set aside for that safety net, right? So life insurance is a great tool for young families. In fact, the hardest estate planning that we can have is not for wealthy and older clients. It's for young families that just started, because there's not so much money that we can play around.
Cash flow is tough.
Cash flow is tough. We can't start to set up trusts because, again, a couple $1,000 at the moment we say the more trust. Yeah. But then again, life insurance. Life insurance is one of the best tools that I propose to my clients, especially when they're young families, to buy, because they're going to have an injection of funds in case of disaster strike, right? Education, okay? And I mean, we hope for them that they can start to enjoy life, travel, and party. But at one point, if they diverge from this path and start to burn their money, and at year 30, they didn't complete their education, that's it. They're screwed. So that's why we really like the strategies using trusts, where we can manage and control the money for the children by reliable trustworthy people that either the client appoint or it can be us as professional trustee or a corporate trustee like a bank. So the money is managed. It's not frozen. It's managed. It can be used and it will be used for the benefit of your children. It can be education, healthcare, housing, allowance, vacation, and everything. So again, you don't want to freeze that money until they reach the age of 30 years old. You just want to make sure that it's controlled in the best interest of your children.
Yeah, so you don't necessarily set a certain age in the will or trust. It's more they have access to it for life-changing events, or they have access to it whenever they want to. So
if we're talking about very young beneficiaries, I like to set up the age to be 30 or 35 years old where they have full control of their money. Okay. Now it depends on the client and it depends on when we do the estate plan, and again, the parents it's not expected for them to pass away anytime soon, and the kids are 25 and they're already in university. I mean, it's fine. We're going to set the age to be 30, 35 years old. Yeah. If the kids are 2 to 3 years old and 5 years old, very, very early to really know.
Yeah, what your child's going to be like.
Exactly.
Is he going to be a drug addict? You have no idea.
Exactly. So that's why I like to set up at least 35 for them. Again, the money is not frozen. So if the trustees, depending on the strategy that we opt, but usually what we do is that we give the power to the trustees to close the trust earlier as soon as they deem the children to be mature and capable.
Okay, so you could always unwind the trust.
Correct. Also, if the children are mature and they're already 40 years old and 50 years old or whatnot, we're also going to recommend setting up trust for them. Why? So the child, who's an adult, can still inherit through a trust, have full asset protection, control, making sure it stays in the royal family, okay, decide who's going to manage the funds, and they can technically give the key to drive the trust to their children. So their children will be in control of the trust. Now in Quebec, small caveat, we always need to have an independent trustee, so a trustee who's not a beneficiary. And then again, if we're ready to give full control of the trust to your children, what we're going to do in the will and in this trust is that we're going to say, my child is going to decide who's going to be the co-trustees. And then again, as we can update over time the estate plan and the will, if one of your child starts to have gambling issues or start to be in a bad divorce or start to be vulnerable, what we can do is just change, fine-tune, and add and define who's going to be that independent trustee to make sure that the money doesn't get.
So you could always change it.
Absolutely.
You could always, if you have someone in mind now, it might not be aligned with your values later. So you could always say, okay, I'm going to switch out that person and put in someone else.
Exactly.
And you don't have to notify that person either.
Nope.
And that
not
person,
even your children.
Exactly, right? So you're not hurting anybody's feelings,
Absolutely.
Stuff like that. And also, that person doesn't necessarily have to say, yes, I want to be, right? If you passed away, let's say somebody passes away and they had a trust and now all of a sudden you're the liquidator. You could refuse to be.
Absolutely.
So it doesn't necessarily mean, like, should someone have a backup plan as well for that?
So we like to always, as much as possible, some people don't really have these options, but most people will, to always have 3 plans. Plan A, B, and C for whatever control or administration role. Liquidator, trustee, mandatory in case of incapacity, personal mandatory to make the healthcare decision. We like to have at least 3 options.
In case someone also passes away and you didn't update it.
Correct. And especially because usually it's going to be the surviving spouse, option A, right?
Yeah.
So if sadly there's a car accident and the spouse, so we're left with 2.
Going with number B.
Right. And there's so many different options and strategies that we can set up with trust. But even in the typical case where our clients are 60 years old and up, and therefore their children are usually 30 years old and up, and also have children, if they're planning to leave $1 million per children, we're still going to recommend trust because the benefits are really, really interesting.
Interesting.
Okay, and if we talk about tax planning, we can actually income split with the trust. The trust can, let's say the trust inherits $1 million for discussion purposes. Well, let's start with the beginning. Let's say your child was supposed to inherit $1 million. Take the $1 million, invest it, generates, for discussion purposes, 5%. Sure. Okay, just 5%. Ordinary income tax at 53% or whatever. Okay, so 5% generate on $1 million, $50,000. You add that $50,000 to their taxable income.
Yeah.
Even if they had a low salary of $30,000, you just add $50,000 taxable income. They get very close to that 50% taxation rate.
Yeah, you're probably in the 38 to 40% range at that point.
Exactly. Now, if they have a salary of $50,000,
Yeah.
and you add another $50,000.
You're at 100.
Yeah. So you're at 100. You really get closer to that 53% marginal tax rate.
Yeah.
Let's say now you set up, and then after paying the taxes on that money, you're only left with half of it, right? Mm-hmm. So half goes to the government, half goes to the children, and that also applies to the salary, which was taxed maybe at a lower rate, right? So you just bump the whole tax rate.
Yeah.
Now, let's say the client set up the trust. Mm-hmm. And instead of the child inheriting that $1 million, it's the trust that inherits. Yeah. So the child keeps their own tax rate. Mm-hmm. The trust inherits a $1 million. Who controls the trust? The child, for discussion purposes. Sure. Does the same thing, invests the 5% at 5%. I'm sorry. Exactly.
So the child will invest it through the trust, $1 million at 5%, will generate $50,000 in the trust.
Correct. At that point, the trusts are taxed at the highest rate all the time. Okay, for discussion purposes, it's going to be 53% or half will go to the government. But at least the child keeps their own lower tax rate. Very good. Where's the tax saving? Okay, you have a nice split here, but let's face it, most people will be, beneficiary will usually reach a higher tax rate. What can happen is that in that case, it's going to be neutral. If the child was already like a professional or doing very well, would have been taxed at 53%. Yeah. And the trust is taxed, it's neutral. Now, where it's very interesting is with the trust, we can income split with all the beneficiaries. Who are going to be the beneficiaries? The child and his descendants. Children, grandchildren. Let's say that a child has 3 children, and we know that children...
You mean a parent has 3 children?
Or no, like...
The beneficiary inside.
The beneficiary, so let's say a child, has 3 children.
Okay, understood.
Okay? So essentially, we know that raising children...
It's costly.
It's very costly, right? Yeah. And let's say for discussion purposes that the personal exemption is $15,000, right? So the trust is only taxed on the net income that stays inside the trust on December 31st. If it pulls the income out of the trust and it remits it to the beneficiary or use it to pay something for the beneficiary, then it's taxable in the hands of the beneficiaries. So let's say that the trust had the son, the client's son, and the son had 3 children. Okay, he doesn't need money, the son, and what he's going to do is he's going to pull $15,000 out of sight of the trust per his children, and we just pulled $45,000 tax-free.
Plus his 15, or you're saying because he's already making money, so he's like
he doesn't need it. So let's say we leave $5,000 inside the trust. The trust is going to tax at 50%.
You'll pay $2,500.
$2,500, but you just pulled $45,000 tax-free.
Correct.
Do the math on 10 years, it's a lot of money, right? So the more children or more descendants that you have, the more you can income split with them, which is amazing.
And imagine also that in that trust, it's not just one kid getting the money, it's maybe 3 kids getting money, and they have also.
For sure. So eventually, the education of the grandchildren, which can be very, very interesting. So I'm just giving an idea of how the trust can be used as a tax planning tool. So the trust is not a tax shelter, it's a tax planning tool. It can be very, very powerful. And let's face it, children cost more than $50,000, right? Yeah. And sometimes we don't have 3 children, we have 1 child. Okay, fine. So you just pull $15,000 tax-free every year, do the math on 10 years.
At least.
It's pretty good, right? And then the rest will be taxed at the children's tax rate.
Correct.
Which is going to be usually much lower than the parents.
Correct.
So that can be very, very interesting.
I love that. Thank you. Thanks for sharing.
Avec grand plaisir.
Yeah.